Good afternoon, everybody, and welcome to Stowe and Deagon's latest webinar series entitled Demystifying Business Valuations. Hi, my name is Marty Croyle from Stowe and Deagon, and today our guest speaker will be my colleague, John Reardon, who is the Director of Consulting Services here at Stowe and Deagon. You want to advance slide, please? Thank you. There's John. So he'll be talking for the next 35 or so minutes, and advance the slide again. We'll do a little housekeeping, please. First, we welcome all of your questions. If you have any, please type them in the Q&A box at the bottom of your screen. If we can't answer your questions today because we run out of time, John or someone else in the firm will get back to you either by email or by phone. So please give us your questions. If you don't catch everything, don't worry about it. This program is being recorded, and you will get a copy of it if you email us. It'll also be up on the Stowe and Deagon YouTube channel shortly, in another day or two. When we're done, you're going to receive a short survey, and we would like you guys, as best you can, to answer the questions on the survey. We're always trying to make sure we're delivering great content and for future webinars, and any suggestions for future webinars. Next slide. So disclaimer, today is May 28, 2024, and in all these webinars we always tell you that this is the best information we have as of today. I don't expect today's topic of valuations to change dramatically, but just bear in mind that things can change. And so if you have any specific questions about business valuations, please contact John Reardon or your main contact at Stowe and Deagon. So next slide.
Thank you, Marty.
Today's agenda, I'm going to turn this over to John Reardon and he'll take over.
Thank you, Marty. Welcome, everybody, and I'd like to thank you for taking the time to participate in this webinar. Here's a look at today's agenda. We're going to cover why do a business valuation, the importance of knowing your audience, how a business valuation is done, things to look out for, and then we'll wrap up with a summary and a quick question and answer period. Okay, reasons for a business valuation. Selling a business, maybe you're getting ready to retire, or maybe you just think this is a good time to exit, or maybe you're looking to just do something else, and so you want to harvest the value that you've created. Gifting of shares, maybe you're looking at some succession planning and you want to give some of the interest in the business to members of your family or to other people. Death, maybe you are the beneficiary of an estate which had a significant interest in a privately held enterprise, and you need to value it for estate tax purposes. Granting of equity, maybe you have some key or critical employees that you want to incentivize and to retain for the longer term, so you want to give them a certain portion of the business. ESOP, employee stock ownership plan, maybe you're looking to create some liquidity for yourself while not giving up entirely control of the company, and share some of the wealth with your loyal employees who helped you create the value that exists today. Divorce, partnership dilution, and or shareholder disputes. Hopefully you don't come into one of those, but those definitely do happen. Next slide. Know your audience. Yourself, if you are a potential buyer, if you're looking to sell, the IRS, if you're looking to do something for gift or estate tax purposes, Department of Labor, if you are forming an ESOP, or an arbitration or a court if you do get involved in a dispute or marital dissolution or shareholder oppression case. Standards of value. There are 4 recognized standards of value, really. There's investment or strategic value. We'll get into each one of them a little further. Fair market value, which is primarily used by the IRS and very similarly for the Department of Labor. Fair value according to GAAP, generally accepted accounting principles. And then there's fair value states' rights. Investment or strategic value. Next slide, please. Investment or strategic value. This is the value to a particular investor. It's not passive. This is somebody who has a specific reason or specific ability to buy your business. The ability to create synergies or expand growth. It could be a competitor. It could be a customer who's looking to backwardly integrate, maybe a supplier who's looking to forwardly integrate, and thinks that they can take your business and combine it with something that they have and extract better synergies and provide maybe better growth. This is probably the hardest to quantify because with a strategic investor, you don't really know what their particular situation is and what they have in mind or what they can believe that they can do with your business. Maybe it's somebody who just believes they can do it better than you. They would be willing to pay a premium for your business, but they're not going to share in 100% of that excess value that they believe they can extract from it. Otherwise, why would they buy it? Next slide. Fair market value. The price at which a property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, both parties having a reasonable knowledge of the relevant facts. A hypothetical buyer and seller are assumed to be able as well as willing to trade and to be well informed about the property and concerning the market for such property. I think the critical factor in takeaway from this slide is that it is a hypothetical buyer and seller. This is a particular situation where you don't know, there's no specifically identifiable buyer or somebody waiting in the wings. This is a hypothetical case. Next slide, fair value according to GAAP, which is not too different from the fair market value according to the IRS, but the price an asset will sell for or the amount paid to transfer a liability in an orderly transaction between market participants at the measurement date. And the takeaway from this slide is that this is an exit value, the cost to exit a particular business or activity. Next slide. Fair value states rights. This is the fair value that you generally wind up using in a dispute or dissolution situation. Fair value states rights can be tricky. It varies from state to state and even can within jurisdiction within those states. I think it's important to kind of remember what they are trying to do or what the adjudicator will do. Well, trying to do what is equitable to the parties involved. And they will generally consider what is the future intent of the parties. There is a famous case here in Massachusetts. It actually took place called Bernier versus Bernier. It was a divorce case. I believe it was a husband or a couple that owned a series of grocery stores, either on Martha's Vineyard or Nantucket, that is starting to become kind of the standard for several different reasons. But that is the standard is being accepted more widely across jurisdictions. Next slide. Valuation approaches. There are generally three recognized approaches to valuing the business. We're not going to cover the third one because it primarily doesn't really apply to most going concerns. It primarily relates to holding companies, but they are in broad strokes the market approach and the income or future benefit stream approach. Under the market approach, there are two different recognized methods: is the recent transactions method and the public companies method. And under the income or future benefits approach, there's the discounted cash flows approach or discounted earnings approach. And these two approaches are really kind of opposite sides of the same coin, because anybody who's buying a business, looking at the market comparables, well, the recent transactions, you're looking at it for the future income stream. Under the market comparables approach, what we're trying to do is by identify the relevant metrics from different entities and apply them to the subject entity. That could be a PE ratio, a multiple of sales, a multiple of gross profit, or a multiple of EBITDA. And for those who are not familiar with the term EBITDA, it's earnings before interest and taxes, depreciation, and amortization. It's analogous to cash flow without the investment in working capital, debt service, and or capital expenditures. Next slide. The problem with the market comparables approach is that your most private entities are not likely comparable to public companies. No matter how good your company is, if you're in the software business, you are not Microsoft or IBM or Oracle. And just because they're trading at 10 to 12 times earnings doesn't mean you will. There's a lack of data on private transactions. Each company is kind of unique. There are databases out there that track all of the, or try to track the various transactions that occur across the country. But the information can be sparse and it can be challenging to try and find a proxy that is a suitable metric for your company. And these investments, because they're usually 100%, are usually strategic or investment value in nature. So there could be a mismatch of standard of value if you're trying to use the market approach for, say, an estate tax return or a shareholder dispute. The future benefit method, and under the future benefit method, like what we're trying to do is measure how much cash will this thing throw off? How risky are those flows? And what are those flows worth today? You're certainly going to be, willing to pay less for something in the future than it is today. Example, under the income approach, we have a specialty medical supplies manufacturer based in Massachusetts. It's been in existence to the mid-1980s. Sales are $10 million a year, growing at 7.5% recently. Total assets are $2.5 million. There's no long-term debt. Approximately 50 employees, net income of $1 million, gross profit of around 3.5, and EBITDA of 2.5. Next slide. Now, under the market approach, we go to our databases and we search and we find that two competitors of a similar size, also based in Massachusetts, sold within the last year. One sold for 7 times gross profit and 5 times EBITDA. One sold for 6 times gross profit and 4 times EBITDA. I mean, easy peasy. It's almost a no-brainer. You can figure out, okay, well, we should trade somewhere within that range if we think that we're on a comparable footing with those other companies. However, the chances of you finding that type of population of comparable companies is pretty slim. Next slide. Much more realistic would be the case that our search of the databases reveals there was a sale of a company with similar sales and gross profit and EBITDA in Florida 10 years ago. There was a sale of a company in Rhode Island 2 years ago with $40 million in sales, $3 million in gross profit, and $6 million in EBITDA. There was a stock sale of a non-specialty manufacturer 4 years ago in Tennessee with $100 million in revenue, $40 million in gross profit, and $50 million in EBITDA. And that company was significantly leveraged. So it gets challenging to try and find, okay, well, which one of these companies could we possibly use as a representative proxy for our company? And how many do we really need? Was one transaction enough? Do we have to look at more? It would be really kind of speculative, I think, to base a valuation only on one transaction. Next slide. Okay. Under the income approach, we expect sales to grow at 7%, 6%, 5%, 4%, and 3% thereafter over the next 5 years. Gross margins are expected to remain the same. Net margins expected to improve with a constant SG&A cost, getting some economies of scale there. There's going to be minimal capital investment over the near term. There will be some additional working capital required. So from that data, next slide, we can create a projection or a P&L. Okay, we can take today's base, the sales at $10 million, and we grow them at that growth rate, and we apply our percentages for gross profit and SG&A. We add back depreciation and amortization, get to our EBITDA number, and then we'd make some assumption, probably based on the growth in sales, around some investment in capital assets and working capital, and then we come up with an after-tax cash flow. And that would be the flow that we're possibly going to get in the future. And then we have to equate that to, okay, well, what is that worth us today? Next slide. And that is done through the discount rate. The discount rate is the mechanism by which we convert future cash flows to something in today's equivalent. It's how much are you willing to pay today to receive X in the future. The rate is reflective of risk because not all investments are the same. If you invest in treasuries or AAA corporate rated bonds, you pretty much know what you're going to get back. If you invest in a biotech startup, not so much. The payoff might be bigger, but there's a greater chance that you receive nothing back in return. These rates are generally determined based upon reference to public company returns. You may have all heard, maybe you took it back in college, some of you, there's the capital asset pricing model, which states that the discount rate is based upon the risk-free rate, the premium for being an equity holder or being in the market itself. And research on this particular subject has indicated that there is a higher risk of smaller companies. So there's a premium added based upon the size of a company, with smaller companies being more likely to go out of business. And then there may be company-specific premiums, things that are idiosyncratic to the subject company that could increase the risk. Maybe there's, a lot of the cash flows are dependent on the founder. Okay, next slide. Normalizing adjustments. These are items when we take a look at the cash flows, things that happened in the past that are not likely to recur in the future, or that won't transfer over to a new buyer. Maybe there are some family members on the payroll. Maybe your wife or daughter does some bookkeeping and really is not necessary to the operations. Maybe there's somebody else on the payroll that's there just drawing a salary and is not critical and would not be paid by a successive owner. Maybe there are excessive owner perquisites. Maybe you have fantastic health plan for yourself and your family members. Maybe your country club membership is being run through the company. I've even seen boats and private school tuition run through the business. And there may be certain one-time events, positive or negative, that have happened in the near past that are not likely to occur in the future. We would consider those things in trying to normalize the cash flow so we can get, this is what we believe will happen in the future. Next slide. Pass-through entities. Now, this is a very unresolved area and kind of contentious within valuation. Pass-through entities are your S corps, your partnerships, your C corps, and for all of those who don't know, that these entities do not pay, these companies do not pay taxes at the entity level. The income is flowed through to the individual owners or partners, and it's paid at their individual tax return. So the question becomes, should you tax affect the earnings at the entity level? This has become less important since the Tax Act of 2017, and that brought the corporate rate down to 21%. But it can still make a difference if you are eligible for that qualified business income deduction. And there is no right answer to this question. It is something that's difficult to try and quantify, and which way you wind up going will depend upon the individual facts and circumstances, and highly related to what the purpose of the valuation is for. The IRS, because in tax affecting the earnings, you're reducing the cash flow and therefore reducing the value of the business. The IRS is dead set against them and believes that they should not be tax affected, because by decreasing the earnings and decreasing the value, you're decreasing the amount of lifetime exemption that you're going to wind up using for gift and estate tax purposes. If you are selling to a C corp, if you do happen to have a software company, and for whatever reason Google or Microsoft was going to buy you, they most likely would tax affect the earnings because they believe that they would pay taxes. So they would deduct the taxes and do the after-tax cash flow. If you were selling to another pass-through entity, hard to say, maybe, maybe not. The thought process there is, why would they bother paying a premium, not tax affect the earnings for something that they could just do themselves? There's nothing unique. They could buy the business and fold it into their existing S corp or C corp, or they could establish a new business and make the election themselves. A dispute or divorce, maybe, maybe not. Again, this would intend to what the parties intend, and this would tie back to that case I was talking about earlier, the Bernier. In that particular case, the husband who owned was getting divorced, said he had no intention of ever selling the business and no intention of ever losing their S corp status. So in that particular case, they did not tax affect the earnings or did not reduce the earnings for the impact of taxes. Next slide. Discounts. Discounts for lack of marketability. Now, public companies, you can sell your shares of Apple or IBM or GM and get your money usually in 2 or 3 days. With a private enterprise, chances are you're going to have to wait a lot longer. So something that cannot be readily convertible into cash is inherently less valuable than something that can be. And quantifying the discount for lack of marketability is somewhat subjective and judgmental. There are various studies out there, restricted stock studies, which track the value of restricted stock for public companies that have both restricted stock and public company stock to see what kind of discounts there can be. But it is entirely somewhat subjective. Lack of control. If you're a minority shareholder, you can't set dividend policy. You can't set corporate direction. You can't probably set salaries, and so certainly being a minority shareholder is inherently less valuable than being 100% or being a control shareholder. Key man discount. Maybe the founder of the company is so crucial, so critical, the CEO to the company. Maybe their knowledge of the industry or their networking ability is such that without them, the company is not as valuable as it is with them in it. So that can be taken into effect. The above are probably most relevant to IRS valuations. They still would apply probably in an outright purchase situation to some degree, but they are most relevant to valuations for IRS situations, and they are probably not applicable to states' rights situations. For shareholder oppression or divorce valuations, generally these types of discounts are not taken into effect. Next slide. Things to watch out for when doing evaluation, unrealistic projections. If you've been going along and you've been growing at 3 to 4% and you're generating $1 million, $2 million in income a year, and all of a sudden you see the hockey stick projection by the end of 5 years, you're going to be growing at 10% and $5 million in income. That's probably not realistic. And the opposite is also true too. It could be a red flag if you are going along and you're fairly successful and you may not be knocking it out of the park, but you're generating a decent income, and then you're trying to project something out and do a valuation based on projection which has business falling off a cliff. That's going to be a red flag as well. Non-relevant comparables, if you are not having enough comparables, valuing your business based upon a company that is really not relevant to your particular company or a transaction that is considerably out of date. Unsupportable discount rates. Discount rates should be reflective of the riskiness of the company. A company that is struggling or has low revenue growth or that's no revenue would be inherently more risky than a company that does. So the discount rate should be reflective of the risk involved. A company may not be the sexiest company out there in the world. Maybe it's not going to be, the next biotech wonder, but it's been going along. It has a good history of earnings, good profitability. It's stable. There's no denigration to its primary market. Well, that type of company should be discounted back at a more conservative rate versus something that is, more speculative in nature. Adjusting for risk 2 times. If you're going to build into your discount rate an increased rate for things that idiosyncratic to the company, such as a key man discount or also a discount for a lack of control or marketability, you don't want to be layering in the discount on top of that again as you come up with the value from your discounted cash flow. If you've already built it into your discount, you don't want to add it in again because you'll be double counting it. Controls for family held businesses, control discounts for family held businesses. This is one of those areas where the IRS likes to challenge. If you give 25% of the business to your son, 25% to your daughter, so that both of them are minority shareholders, but between the three you hold 100% of the company. That's one of those areas, that gray areas, the IRS likes to challenge. Sometimes they prevail, sometimes they don't. It's just something to be cognizant of. and using the incorrect standard of value. If you're doing a valuation for gift and estate tax purposes, you don't want to be basing it on strategic value or states' rights value. You want to make sure you have the standard of value that meets the purpose of the report. Next slide. So, in summary, business valuations quantify value not directly observable by reference to proxies that are. It's more than a gut feel. I won't so far as to say that it's scientific, but we try to put a rational methodology, defendable methodology behind what the value is. The importance of knowing the end user of the valuation, who is going to be reading the report, that is critical. I think you need to know that up front. Is it going to be read by just yourself? Is it going to be read by the IRS? Could it possibly wind up in front of a judge or an arbiter? It is critical to understand who is going to be the end user of that report. And I think next slide. And at this point, I think I'm going to turn it over to Marty for any questions that may have come up.
Thank you, John. Great job. We do have a few questions here, and if you want to add questions, please put them in the Q&A box, and I'll make sure I let John know about them. So, John, you mentioned the term EBITDA, and you explained that it was earnings before interest, taxes, depreciation, and amortization. You talked about those normalization entries, and you talked about multiples. Can you dive a little bit deeper into multiples? And, I've heard people talk about multiples between 2 and 12 and times. And can you just kind of walk through what drives what size of the multiple that your business is going to have?
It would depend upon the industry for the most part. I mean, you're right. I mean, they can range anywhere from 2 to 12. I mean, certainly something in the technology space, or the software and or biotech area seem to be driving unbelievable multiples nowadays. But it generally varies from industry to industry, which is the importance, I think, when we talked earlier, of identifying the correct proxy or the correct comparable company. You don't want to be comparing yourself to a company that has a great multiple that you're just really not comparable to. So it really is kind of an industry specific thing.
Got it. Got it. And valuations, here's a question. This gentleman has a business and he wants to start getting value out of his own estate and passing it on to some of his children. You talked about lack of marketability, and you talked about what was the other one?
Lack of control.
Lack of control as a minority partner or a stockholder. Is there a safe number that the IRS will live with? I know
That's a really good question. I don't know
topical
if there's
question, but
there is no safe number, but certainly the higher you go, the more likely it is to be challenged. I would say anything underneath 25% for both, like 25% for lack of liquidity or lack of marketability, and 25% for lack of control is reasonable. Anything above that, you might start to get some red flags, but that doesn't mean that it's not applicable, particularly in situations where you have companies that have shareholder restrictions on transfer. It can only be sold to a family member or somebody else, or that the company has right of first refusal. So it could go higher
yeah,
depending upon the situation, but you have to be able to defend it. And like anything, I guess the higher it goes, the more likely you are to get questions on it.
got it, got it. There's another question about states' rights. Could you dive a little bit deeper into states' rights and let's see, what does it say? How and who decides which states control?
Well, it would depend upon the state or the jurisdiction in which the action is brought, which could be most likely the jurisdiction in which the company is domiciled, although I think it could actually be possibly in the state in which it was registered. So if you had a company that was registered in Delaware and was based in
Mhm.
Massachusetts, you could wind up actually in Delaware. And it's kind of really a question. If you're at that stage, you probably, get legal counsel involved. And that's kind of question really for legal counsel to say that, what is the standard of value in this particular jurisdiction?
Got it, got it. Let's see, what's the multiple? Here's another one. A typical discount rate, you were talking about discount rates. Again, is there a typical rate that one can use to be
I would
safe?
say for private companies, discount rates, depending upon the entity, could range anywhere from 15 to 30%. 30% being on the high side, I think, for something that has a lack of earnings track record, or something that is higher risk in nature, something that doesn't have a long history of positive cash flows. But 20% is probably a good proxy for something that is non-startup in nature,
Mhm.
something that does have an existing revenue stream and an existing client base. Clearly, for something that's on the angel investor side, or something that's little to no revenue, then you discount rates 30 to 40% or even 50% would not be out of the question.
Got it, got it. Here is another one. Does a evaluation person ever use more than one of the methods that you described to come up with the valuation?
Yeah, yes, that's certainly the case. I mean, valuation, first of all, valuation is rarely a specific number, it's more often a range, but it is, definitely, I would say, not only possible, but probably advisable to use multiple methods and to assign weightings to them. You may do something under the discounted cash flows method, and something under the market approach, either based on, multiple of EBITDA, multiple of sales, multiple of gross profit, and maybe even, a public company comparable if you think you have one, and then do some sort of weighted average where maybe you're only granting 20% weighting to the market comparables and 40 or 50% weighting to the income approach, or vice versa. But yeah, more often than not, you're going to wind up seeing more than one method used, and some sort of weighting average, unless one of them comes out with a completely ridiculous value, which does happen sometimes. We're going to say that's just an outlier and it just really can't be supported.
So when you finish evaluation report, is it going to be a number, or is it likely to be a range between these
Could be,
different methodologies?
could be both, but it could be both. It could be a range, somewhere between, depending on who the audience is. If we're doing
Got it.
something for the IRS, it's probably going to be a specific number. If you're doing something for a shareholder dissolution, or something for your own, a buyout, or personal who's looking to sell, it could be a range.
Got it. Got it. I've been talking to here's a question from a business owner, apparently. I've been talking to a business broker, and he is asking me to go back 3 to 5 years in my income statement and calculate EBITDA. That seems like it's the opposite of projecting the earnings of the future cash flow, but is that a way to go too?
No, I mean that's something we would do to project the earnings. We would start with what they have been in the last 3 to 5 years, and we probably
Okay,
would calculate some sort of cash flow and some valuation just based upon the recent history, and then we would also use that history to do the projection, and we would take into the projection, um, if there was a reason for the projection to be higher or lower than history. So no, that's perfectly reasonable, and that's something we would do in doing a valuation. We would look at recent history as a
got it.
sanity check on whatever we would come up with for a forecast or projection.
So would you also introduce the weighted average there and weight more of the valuation to the more current year and less to
It
2 or 3
depends.
or 4 years ago?
It would depend on, like, certainly if we're looking backwards 5 years, we're going to catch a couple of years of COVID in there, and we're not
Uh-huh,
going to rely on those at all. We're going to look at them and say, okay, well, those are outliers, just throw those out because that just is not indicative of what's possible to come in the future. And if there was some other reason to look at the future and say that maybe the company in question had just secured a patent, or had just developed some radical new technology that sales had just started. So maybe in the last 2 years, their sales have grown at 20% per year versus they had been growing slower, in the previous years because they solved some technical problem that they had in the past, or maybe they expanding into a different market. Maybe they've gone through an acquisition themselves recently, and now they're looking a lot different going forward than they have in the past. But we would look at both. But yeah, there's reasons we wouldn't necessarily assign them equal weighting. And we were trying to understand what would be the reason for why the projection would be so different than the recent past.
Okay. Well, we got one more question, and I guess it would be, what's the hardest thing about doing evaluation? And they do seem to be subjective in nature,
Yeah, I mean,
or somewhat subjective in nature. That's probably a better way to put it.
the hardest thing to do is actually, I think, under the market approach is to find realistic proxies, because the
Mhm.
data is so sparse, and because you don't get perfect information as to exactly what the motivation of the buyer is, which is why I tend to underweight things under the market approach, and way more heavily on the income approach, but not disregard it entirely. So I think it's, you know two things is probably, trying to find a reasonable proxy based upon the market approach, and then trying to develop a really decent cash flow, to understand, okay, well, looking through the numbers and say, this is what happened in the past. Is this a good or reasonable proxy as to what somebody can expect in the future? And really understand those normalizing adjustments, that we have. And, are those reasonable? And make sure you capture all of them, because sometimes you may not capture all of them.
Got it. Well, those are all the questions that we have. Does anybody have any in the audience have any last minute questions? And if not, John, excellent job going over a very difficult topic. And as you explained, you can use valuations for a lot of different reasons. You could be wanting to sell your company and you want a high valuation. You might be getting divorced and you want low valuation. You might be in a dispute. And so there's lots of different ramifications of valuations, and they are difficult to do. And we thank you for spelling it out and making it a little bit simpler for us, for those of us who don't do it on a regular basis, to understand the basics. So if anybody in the audience has any questions, please feel free to contact John, either by phone or by email, or contact your main contact at Stone Degon, and we will get back to you with answers. And you will get, again, this program is being recorded. So if you want to watch it again, or you have a colleague in your business that you'd like to watch it, you can watch it again. It'll also be up in our YouTube channel in a couple of days. So, and then you'll have a short survey, and please fill that out and let us know if there are any future topics you'd like us to cover in the future. So that's all for me. And John, I'll let you sign off.
Thank you very much for everyone for attending, and feel free to reach out if you have any question or would like any further information.
All right, great. Hope everybody has a great afternoon. Thank you for attending.